Welcome to the Deep Dive. Today, we are jumping right into the Q3 Fiscal 2026 earnings call from after the bell yesterday, December 2nd, 2025.
And our mission today is really to cut through the noise. We're going to hit the key numbers, of course, but then we have to unpack this huge strategic shift to AI.
Right.
And, we need to solve the central puzzle of this whole thing. Why did the quarter that was by all measures a huge financial beat still get such a choppy reaction for the market?
Okay, so let's start with those results, because on paper, they look fantastic. A clear win on top and bottom lines.
Absolutely.
If you look at the adjusted number, the non-GAAP EPS, they delivered $0.82. I mean, that just blew past the consensus of zeros and 75.
That's a 9% surprise. Right. That's not small. And it's not just some accounting trick either. You look at their GAAP EPS, the real number, it's $0.24.
Which is a huge deal considering where they were.
A huge deal. A year ago, they were basically at zero. So that shows real fundamental financial maturity. And revenue was a beat too. Came in at $742 million when the street was looking for $730 million.
So, okay, they beat on revenue, they crushed EPS, showed massive improvement. Why did the stock trade down 3.5% after hours? It doesn't add up.
Exactly. This is where you see investors talking. They were basically saying, okay, great. We know you can manage costs now. We get it.
Show us the growth.
Show us the growth acceleration.
Yeah.
The negative reaction tells you everything you need to know. The cautious outlook, which we'll get to, it just completely steamrolled the great results from Q3. It signals this deep skepticism about getting back to, mid-teens growth.
All right, let's unpack that execution, though, because the story of how they got here operationally is actually pretty phenomenal.
It's the story of the quarter, really. Their non-GAAP operating margin hit 24%. Just think about that.
That's a 300 basis point jump year over year.
It is. And that doesn't just happen. That's disciplined spending. That's a focused go-to-market. It's slowing down OPEX growth. It's hard work.
And all that discipline, it turns directly into cash, right?
It really does. The cash flow is incredible.
Yeah.
Operating cash flow was $218 million. It's a 29% margin.
Wow.
And almost all of that became free cash flow, $211 million. So that's a 28% margin. It was 23% a year ago. Management is very deliberately calling this their pivot to profitable AI-levered platform growth. The key word there is profitable.
And we've seen them use that cash pretty wisely to de-risk the whole company. Let's talk about the balance sheet for a second.
Absolutely. They're sitting on a huge pile of cash. It's, $2.463 billion in cash and investments.
Yeah.
And critically, they used a chunk of that to pay off their debt. They settled the last $510 million of their 2025 notes. That's huge.
So that's almost totally cleaned up now.
Almost. All that's left is $350 million in 2026 notes. So the whole structure is just way more robust now and gives them a lot of options.
Okay, so that's the good news. Pristine report card on margins, on cash, on the balance sheet. But the market cares about growth.
The market only cares about growth.
And those indicators, while solid, are what fueled that unspectacular feeling that sent the stock down.
Right. Revenue grew 12% year over year, which is fine. It's solid. But it's not accelerating. And to see the future, you have to look at the backlog.
The RPO, remaining performance obligation.
Exactly. All the money from contracts they've already signed. Total RPO grew 17% year over year. Sounds great.
But the devil's in the details. It's all about the current RPO.
You got it. The CRPO. The piece of the backlog they expect to recognize as revenue in the next 12 months. And that growth was slower. Just 13% year over year. And that gap between the 17% total and the 13% current, that's where analysts start to get a little twitchy. It suggests the immediate acceleration isn't quite there.
And to back that up, dollar-based net retention, which is just a measure of how much existing customers spend, was flat, 106%.
Which again is a good number. It means they're selling more stuff to their existing base.
Yeah.
But, in the software world, 106% isn't setting the world on fire. It's steady. It confirmed they're still in this low double-digit growth mode.
So this is the exact moment management needs to pivot the story. And they did. They went all in on the big theme. AI CEO Todd McKinnon basically framed them as the neutral identity layer for all of AI.
And it's a brilliant pivot. The core argument is that AI agents, these non-human identities, will actually increase the need for identity security.
Not replace it.
Not replace it, but make it more critical.
Yeah.
Identity becomes the control point for a world filled with autonomous software. It's a really compelling story.
We should probably define agentic workloads because that term is like central to everything they're planning.
Yeah, good point. So think of them as non-human workers. It's code, it's bots, it's AI programs that need to securely log into your company system.
Like a financial database or customer info?
Exactly. If an AI agent is writing code on behalf of your engineer, that agent is an identity. It needs to be managed and secured just like a person.
Which brings us to the new products. Okta secures AI and Auth for AI agents. And here's the billion-dollar question. How are they pricing this? Are these agents just cheap service accounts?
This is the genius part. No. They are treating them and pricing them similar to traditional human seats. It's an aggressive move.
Wow.
So management sees AI adoption as just more users. More AI means more identities to secure, which means more revenue for them. It expands their market overnight without changing their business model.
That is the ultimate monetization play. Did they show any proof that this is actually working yet?
They did, and it was pretty compelling. They said they're already talking to over 100 current customers about these new tools.
And those aren't small customers.
No, they represent over $200 million in existing annual recurring revenue. So it's a huge base they can start upselling immediately.
They gave that one specific example that I thought was really powerful.
The financial services customer.
Yeah.
They signed them up for also, for AI agents, and management said it resulted in a significant ACV uplift.
Average contract value.
Right. And that's the proof point investors needed to see. It shows that securing AI isn't some fuzzy future idea. It's driving bigger deals today.
And in the Q&A, they really pushed the competitive angle, didn't they? The idea of being neutral.
They hammered it home.
Right.
The message was, look, in this new AI world, you can't get locked into one platform. You can't just rely on Microsoft or Google for everything.
Because it's too risky down the road.
Exactly. They're pitching themselves as the flexible, best-of-breed choice for identity. It's a classic security play.
But let's go back to how big this could be, because they threw out a number, an agent-to-human ratio, that was just mind-boggling.
It was. They suggested a ratio of 5 to 10 agents per person.
10 agents for every software engineer.
Yeah, imagine that. One engineer with 10 bots, writing code, running tests, checking databases for them. If that plays out, I mean, the market for securing non-human identities could be bigger than their entire business is today.
Okay, but here's the tension. If the opportunity is that massive and the strategy is ready, why are they only guiding for 10% growth next quarter? That's the disconnect.
That is the million-dollar question.
Yeah.
It brings us back to the guidance. They did raise the full-year outlook a little bit.
Which is good.
It's always good. But it wasn't the explosion everyone on the buy side was hoping for.
So lay out the numbers for us.
Okay, so for the full fiscal year 26, they raised revenue guidance to about $2.9 billion, which is around 11% year-over-year growth. And again, they raised the operating margin target to 26%. So more profit.
But for Q4,
For Q4, revenue guidance implies only about 10% growth, and they're targeting a free cash flow margin of around 31%.
I see the problem. The market isn't going to reward 11% growth, even if it comes with these amazing margins. They want 15% growth, even if it means lower margins.
Precisely. The guidance just confirmed this, prudent, steady growth story. Management talked up sales productivity, which is great, and they even started hiring again for the first time in 3 years.
To get ready for the AI demand.
To get ready for the demand they hope will come. But the real flashpoint, the thing that I think really sank the stock after hours, was holding back the full FY27 guidance.
That was a bad move.
It was a conservative move that totally backfired. The CFO said, Q4 is our biggest quarter, so it's not helpful to project 5 quarters out. But the market heard, we're not confident we can accelerate.
And then he gave everyone that algebra lesson.
Oh, the infamous algebra lesson. Yeah. Since he wouldn't give a number, he told analysts how to calculate it themselves.
Which is never a good sign.
Never. He basically said, take our Q4 CRPO guide, divide it by this coverage ratio, add some professional services, and what do you get?
A low growth number.
You get a low growth number. The math points to something like 9.5% growth for FY27.
Yeah.
So he basically confirmed the cautious outlook without ever saying the number out loud. It was not great.
So if we step back, why is the market punishing this so much? I mean, lots of companies are being cautious.
It's because of the performance gap. You have to remember, the stock was already down 10% the month before the call.
And it's been lagging its peers.
Dramatically. This cybersecurity ETF, CIBR, was up like 23% over the last year. So investors are looking at this company with its incredible margins, and they're treating it like a utility, not a growth stock. They just don't believe it can get back to mid-teens growth and keep those margins.
The execution on discipline has been perfect, but the execution on growth acceleration, that's the missing piece.
That's the disconnect. Operational excellence is priced in. The growth story is not.
Well, it is time for our final segment. This is not financial advice. This is where we pitch a wild but maybe plausible trade idea based on what we've just discussed. And a reminder, we are not financial advisors. Please do not act on this.
Okay, so the core tension we've established is this. Amazing operational execution and a fortress balance sheet on one side.
And total investor skepticism about growth on the other.
Exactly. They're being penalized for being too cautious and for holding way too much cash for a company that's supposedly maturing into a compounder.
So what's the move? What's the trade to fix that confidence gap?
The trade. They have $2.463 billion in cash. They should immediately deploy a small piece of it, say $400 to $500 million, to send a huge signal to the market.
How?
Two things. First, aggressively buy back the remaining $350 million of their 2026 notes. Just get it off the books. Done. Second, at the same time, announce a small symbolic share buyback, something like 1% of the remaining cash.
That is a very sharp, very specific capital allocation signal. What does that tell the street?
It screams decisive maturity.
Yeah.
Retiring the debt finishes the cleanup story.
Yeah.
But the buyback.
Yeah.
The buyback is the real message. It says management believes their stock is cheap after this sell-off. It says they are so confident in future cash flow that they're willing to start returning capital to shareholders. It could force a re-rating by showing investors they're not just a cash hoarder, they're a mature, durable compounder.
So this quarter was really the story of a company firing on all cylinders when it comes to profit and cash, while also laying out this visionary strategy for AI.
Absolutely. But all that success is being held hostage by cautious guidance and, frankly, investor impatience. The entire long-term story now rests on one question. Can Oz for AI agents and Okta Secures AI turn from a good story into actual meaningful revenue growth?
Something better than that 11% they're projecting.
Exactly. Until they deliver tangible AI-driven acceleration, they risk being stuck with this show-me discount, no matter how amazing their free cash flow gets. That's the challenge they face now.